A strategic plan to build back stronger in a narrow window of opportunity during COVID-19. Singapore Deputy Prime Minister and Finance Minister Heng Keat said this of the budget during his closing speech in Parliament today. About 20 years of fiscal surpluses have already been drawn from past reserves so far, and billions used to transform the economy and give relief. Mr. Heng said this means the government must spend even more carefully in the years ahead.
Up to $53.7 billion. That's how much Singapore is prepared to draw from its past reserves to support businesses and save jobs during COVID-19. Deputy Prime Minister and Finance Minister Heng Keat says further draws from reserves may be needed if the situation turns sour. These will be used to make economic investments for the long term. Whatever the case, he says the government must build back the coffers.
As a crisis response to COVID-19, we have drawn from the past reserves an amount equivalent to about 20 years of financial surpluses. It will be a challenge to also make good this amount drawn given the magnitude of the crisis. This is a crisis fund function of the reserves. Nonetheless, we should strive to remain fiscally prudent to build back our reserves gradually. The fiscal situation ahead will be very challenging, but I believe that members agree on several issues. There is scope to do more, to take better care of Singaporeans, especially the more vulnerable. With that, we'll need to find the resources to do so.
But Singaporeans are getting older as a population, with current taxes not enough to pay for social spending. For healthcare alone, it's set to rise by up to 30% by the end of this decade. Mr. Heng says even raising the goods and services tax won't give ample cover.
Since 2007, we have already increased various taxes to collect more from those with more means, which are then transferred to our lower income. All this while, over the 14 years, the GST rate has remained unchanged at 7%. We will be in a budget deficit if not for the contribution from reserves in the form of net investment returns contribution, or NIRC. Economic growth alone is not likely to raise enough revenues to meet our needs. The honest but hard conclusion is that we will need to raise more tax revenue.
As to MP's suggestions of a wealth tax on the more well-off, Mr. Heng agrees there's scope to review this. But he says that alone isn't enough to replace the impending GST hike. He also took issue with suggestions to use proceeds from land sales.
We should treat our land as a scarce and finite asset. Selling land does not give the government more resources and should not directly support our expenditure. Instead, we sell the land that we need to sell for urban development and invest the proceeds. Once the government gets used to relying on land sales to fund spending, the government has a vested interest to keep land prices high or to sell more land. Both options are terrible. And we can see the distortionary effects on the welfare of people in places where local governments rely on land sales for revenue.
To take pressure off current spending, the government wants to issue bonds worth up to $90 billion to borrow and pay for long-term infrastructure. It's doing so for the first time in decades. But Mr. Heng cautioned against borrowing to fund soft capital such as education, which one MP says is a type of long-term investment.
We have to refrain from the temptation to borrow for what are essentially recurrent expenditures. In many countries, there is a tendency to expand the scope of what constitutes soft capital beyond the original intentions. When use of fund increases to government subsidies or social transfer, it is really more recurrent spending. Borrowing continuously for them will just lead to ever higher debts.
Mr. Heng assured MPs that the government will put in safeguards, like a limit on borrowing and ways to make sure rising interest rates won't burden future generations.